Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Jordan Woods, Portfolio Manager at Paradice Investment Management. He's going to be talking about why the often overlooked mid-cap space is offering compelling opportunities for investors today. Welcome, Jordan.
Thanks very much for having me, Anna.
Small caps have dominated Livewire's headlines for the past couple of months. Can you lay out the case for mid-caps and why this part of the market deserves attention right now?
If you were to look at what we've seen over the last couple of decades, mid-caps have actually been the strongest returning part of the market. But even when you break up the ASX 300 into three segments, the way we look at it is you have the ASX 50, so those top 50 companies, the mid-cap 50, which are stocks 51 to 100, and then the small ords. If you were to break down those three parts of the market and we were to look at the return series over time, mid-caps actually do generate the strongest returns. And how do we define that and how do we look at that? We look at it by looking at the median holding returns over the last 25 years. So for example, if we were to look at the last 25 years and look at the median holding return for those three different parts of the market, mid-caps have actually sit right at the top of that. So let's take 3 years, for example. If you would have held the ASX Small Ords for exactly 3 years, the median return of that would have been 5.8%. If you had have held the ASX 50 for exactly 3 years, you would have generated the median holding return for that was 8.5%. And for the mid-cap 50, the median holding 3-year return over the last 25 years, again, was 11.8%. So really quite strong. Now, what's interesting is if you increase that holding period to 5, 7, or 10 years, the story stays exactly the same. So what does that mean? It means the chances are if you held the mid-cap 50 for exactly 3, 5, 7 or 10 years, the chances are that you were holding the strongest part of the Aussie equity market. So for us, it's a really attractive part of the market. The other thing that's gaining a lot of attention at the moment as well is the dominance of the banks in the top 50. And I don't think there's probably a week that goes by without anyone talking about what's happened with CBA, and people are probably sick of hearing about it. But if we look at the makeup of the top 50 now as well, it's quite dominated by financials. So nearly 40% of the top 50 is actually financials, which is largely banks. And then if you include the resource companies and the materials within that, it's nearly 60%. So it's a really concentrated part of the market. Then if you look at the last 5 years, total return contribution to the top 50, 60% of that has come from the financials part of the market as well. So if you look at the total returns for the top 50, it's been very concentrated. And even as we sit here today, it is very concentrated. Now, on the flip side, if you look at the ASX mid-cap 50, the diversity of sectors is a lot more broad-based. We have a much more broad-based set of sectors and a whole bunch of companies that sit across the mid-cap 50. And again, if you were to look at the 5-year total return contribution for the mid-cap 50, there's only been the largest single stock contributor to that was actually WiseTech at around about 7%. So the breadth that sits within the mid-cap 50 is much broader compared to the ASX 50, and it's becoming a big challenge for a lot of investors at the moment because they're realising that it is difficult to find value in the top 50 part of the market. So hence why mid-caps are becoming a really attractive part of the market for a lot of people. On the flip side, we have seen the ASX Small Ords continue to do well. But again, what probably gets a little bit lost is that when we see these really strong periods of the ASX Small Ords, the mid-caps actually normally outperform in those environments. So for example, we saw that coming out of COVID. From the bottom of COVID to the very top of that cycle, we actually saw mid-caps outperform. So when you look at the mid-cap 50 relative to the top 50 and to the Small Ords, it's a really strong part of the market and it often does get overlooked. So it's something that we really try and highlight to people and think it's definitely something that deserves an allocation in a lot of Aussie equity portfolios.
So how is Paradice thinking about the macro landscape with interest rates, inflation and the growth outlook? And what does that mean for mid-caps?
Yeah, we tend to not really focus too much on the macro. It is something that we keep one eye on. In terms of the way that we look at things, we're very much bottom up. Now, that's not to say we don't obviously keep an eye on the macro. So what we're seeing at the moment is it's actually a relatively positive environment and we're pretty cautiously optimistic for the outlook as we look forward. So what we have seen is rates have continued to come down, and we've seen this perfect deleveraging cycle where we have seen a soft landing play out, where we saw the mortgage cliff we were talking about a couple of years ago, and everyone was waiting for the mortgage cliff to roll over. We've seen rates, go through that lowering cycle. We've seen inflation come down, and we've seen unemployment being able to stay relatively stable through that whole environment. So as we look forward, things look to have played out pretty well, and even moving forward, we think that the macro environment continues to look really positive for equities. Albeit you will see periods of volatility, but as equity investors and investing in equity markets, you always need to look through those periods of volatility, and mid-caps is exactly one of those parts of the market that can really benefit from that.
You've shown that mid-caps have historically delivered the strongest returns and earning growths in the Australian market. What's driving that structural outperformance?
Yeah. Understandably, earnings drive share prices over the long term, and that's no different to the mid-cap 50. If you were to look at the EPS CAGR over the last 3, 5, 7 or 10 years, again, the mid-cap 50 has shown the strongest EPS growth through all of those timeframes. So you're consistently seeing really strong earnings growth continually come through in the mid-cap 50. If you were to break down why that is, you have to think about where the mid-cap 50 sits in the broader ASX 300. So if you think about the mid-cap 50, it really sees the best of both worlds. So what we get is really good small caps coming up and migrating to be mid-caps. So what that means is you can really think of the mid-cap 50 as this really high-quality small cap part of the market, because for every really good small cap that does well, it eventually migrates up to be a mid-cap. And then on the flip side, you get those fallen angels from the top 50. And two things normally happen with those names. They either come into the mid-cap 50 from the top 50, they have the turnaround stories and they rebound, turn around the business, go through some sort of management change, cyclical change, and eventually come up into the top 50 again. Alternatively, they're just structural decliners and we ultimately avoid them, and they do turn out to be small caps over time. So for us, what are you really trying to look for? In the mid-cap 50, you're really trying to look for those really good small caps that are going to migrate up and be mid-caps and really compound their earnings growth through the mids into the top 50. And on the flip side, you're really monitoring those names that come out of the top 50 into the mid-cap 50, and you really got to assess them and say, are they turnaround stories? Can they change? And can they ultimately be top 50 companies at one point in time? Or are they structural decliners and eventually become small caps? So they're the sort of the two large makeups of the mid cap part of the market.
Double the opportunity almost.
Yeah, exactly right.
Let's talk valuation. Where do you see current opportunities? Are mid caps still attractively priced after the recent rally?
Yeah. Again, maybe just on that, it's interesting. I think if we look back in history again and you look at the performance of markets, when you see these really strong periods of performance in small caps, not only do you see mid caps keep up with that, but they actually normally outperform. And we've seen that in recent cycles. So for example, from February to the very lows of COVID, we saw mid caps and small caps actually fall exactly the same. They both were down about 37%. From the bottom of COVID to the very peak of the cycle, we actually saw mid-caps up about 130%, and we saw the small ords up around about 105%. Now, it's interesting, through that part and coming out of COVID, there was a lot of talk about small caps, and understandably, because they did really well. But again, one of the things that probably gets a little bit overlooked is that mid-caps actually did even better during that outperformance. Then if you look at the preceding 3 years after that, we actually saw mid-caps continue to increase that outperformance. And if you look at the last 3 years, what we've just gone through, we've seen a number of significant macroeconomic events. So the first one was the Russia-Ukraine invasion. We saw interest rates start to hike. We've seen Trump tariffs come in. We've seen a whole bunch of geopolitical pressures arise as well. And even on that basis, again, you've seen mid-caps outperform quite significantly. So to your question around, looking forward, what do we see? It comes back again to what the mid-cap part of the market is made up of. It's the really high quality small cap companies that migrate up. So they're proven businesses that have got really strong earnings growth, and they compound through these volatile periods. So yes, you see these short-term fluctuations and volatility in markets, but people probably often forget that there's strong underlying fundamentals that sit behind these mid-caps, compounding really, really strong earnings growth, which is what drives that outperformance in mid-caps. So going forward, do we think that dynamic will change? No. The mid-cap part of the market is consistently made up of these names, and it's always changing, so you're consistently getting fresh ideas come through. And again, that earnings growth is always compounding through and doing really well. So even as we look forward, the forward earnings growth for the mid-cap 50 is around about 25%, so it's still really healthy. And if you were to break that down, there's a whole bunch of really high quality companies that are driving that earnings growth.
So how does your team go about finding these opportunities, and what does your process look like in practice?
For us, as I mentioned before, we're very much bottom-up stock pickers. That's the bread and butter of what we do. So with that, it means that we start with our investment universe. Our investment universe is the X50. So for us, 80% of our portfolio is invested in that ASX mid-cap 50, but the total investable universe is really the X50 all the way down to the 300th company. So for us, we look at everything. We spend a lot of time on the road, so idea generation comes from everywhere. We don't have any travel budgets at Paradice, so we probably do anywhere from 3 to 4 international trips a year, and we do lots of domestic travel, and we spend a lot of time seeing companies. And from that is always sparking new ideas. And in fact, that goes all the way back to the inception of Paradice, and it was one of David Paradice's very sort of founding principles of stock selection and how you find really good companies. Once we've gone through the universe, largely through conversations with management teams, brokers, expert networks, competitors, suppliers and so forth. There's a whole range of ideas that come back from that. From there, that's when we do a little bit of a deeper dive and we really start to get in the crux of the financial model. And us as a team, I have 2 other colleagues that work alongside me. We really start to dig deep and start to focus on the bottom-up fundamentals. That's where we run the financial analysis. And ultimately, what are we looking for? We're looking for businesses that can have really strong compounded earnings growth through the cycle. They can reinvest their capital at really high return on invested capital. And then ultimately, they've got some sort of catalyst to re-rate. Because if you've got businesses that are growing strongly from an earnings perspective and re-rating, ultimately through the cycle, you'll see some really strong performance.
Could you share 1 or 2 stock examples, perhaps a long-term performer that continues to deliver and a newer addition that you're excited about?
Yeah, there's always plenty to talk about in mid caps and even the new names coming up through the small caps as well. In terms of one name that's done really well for us and even now we continue to like is ALS. ALS is one of those businesses I was just talking about before where you can see that strong earnings growth and that even continues on for a multi-year period, and you see a re-rating potential and you're seeing that reinvestment of capital back into the business at really high returns. So if we look at ALS, there's 2 parts to that business. It's largely life sciences, which is about 50% of the earnings, and commodities, which is about 50% of earnings. If you look at the life sciences business, we're relatively unfazed with that. It does really well, so we don't lose too much sleep with that part of the business. Again, you're always seeing organic top line growth of around about high single digits. So you're seeing 7 to 9% top line organic revenue growth through the cycle. Along with that, you do start to see some margin expansion flow through. So just on an underlying organic basis, you start to see double-digit earnings growth. On top of that, they're always reinvesting on small bolt-on acquisitions, which gives you another couple of % of earnings growth. So that's a relatively stable part of the business and always probably less exciting than the commodities, but really underpins the long-term earnings growth. Then it brings us to the commodities business. If you look at the commodities business, that's really all about exploration volumes within the resources sector. So as we're all talking about and well aware is gold and what's happening with the gold price. When you see a really high gold price, you see a lot of junior and senior resource companies actually raise money to throw into the ground for exploration. And that's exactly what's playing out at the moment. So if we look more recently and we look at what's been happening with the raising data, that's been extremely strong. And what this means for ALS is as that money's put into the ground and the drillers start to drill out those core samples, that ultimately makes its way to the ALS sample labs for testing to find out what's in the resource. And as ultimately those sample flows come through, you start to see some really strong operating leverage come through in the business. So we've just come off the back of a couple of years of lack of exploration spend. We're now seeing a cycle of really increased exploration spend, which means we'll start to see some really strong top line growth for ALS mixed with margin expansion. And the operating leverage within that commodities business can be quite extreme. So the earnings upgrade cycle we believe we're about to see for ALS is really quite strong. A newer one we've just put in the portfolio is SRG Global. We've owned the stock for a couple of months now and have been very impressed with management. If we go back to the original thesis there, they're a mining services contractor, but not your typical lower quality contractor, we would say. If you look at a big part of their revenue base and their contract book, it's largely industrial maintenance type work. So this is long dated schedule of rates type of work. So in terms of the contract risk that sits within it, it's relatively lower down the risk profile compared to some of your larger lump sum construction type businesses. So what we've seen, the CEO there, David McGeorge, has done a fantastic job. We were really impressed with him when we first met him. He actually said to us in the first meeting we had with him, he says, I don't like speaking to investors because I'd much prefer to be out running the business. And we love hearing things like that because it means that he's a serious type of guy. More recently, we've just seen them do a small bolt-on acquisition, and that was at least 25% EPS accretive. We think there's going to be more of those to come. They're smaller bolt-on type acquisitions. They're significantly accretive. They've got a really strong track record of doing some of these smaller bolt-on acquisitions, integrating them and actually delivering synergies from them. So as long as that continues, this is a business that we think has got a long way to run and we're pretty excited about. So yeah, SRG is an exciting opportunity for us.
Okay, great. On the flip side, what's a position you've exited recently and what prompted that decision?
Breville Group, we were relatively optimistic on going into the result and even in coming out of the result and looking at what they're doing in terms of diversifying their supply chain. Post some analysis and working through some of these tariff issues, we've sort of worked through the COGS base or the cost base within the business and trying to understand what the true impact of tariffs are going to be on that business. As we've worked through some of that analysis, unfortunately it looks like it's going to be something quite difficult to offset. From what we can see is the pricing rises or the price rises that we're putting through won't be significant enough to really offset the inflation impacts. So we think it'll be a scenario of really high top line revenue growth, but unfortunately you're going to see some pretty strong margin compression this year. And in terms of where consensus expectations are for that business, unfortunately we believe there's probably some downgrades to come in the short term. Now that's not to say we're really excited about the medium to longer term opportunity for Breville. We do think there's a much longer growth runway for this business, but in terms of just managing risk in the portfolio and looking forward, we think there's some short-term earnings headwinds that we'd prefer to avoid.
Yeah, sure. So you've managed the strategy for nearly 2 decades. Now it's being launched as an ETF. What was behind that move and how does it fit into Paradice's broader approach?
We've been really lucky at Paradice where we've had some really strong backing from all of our institutional clients, and to this day we still have some really strong backing from those institutional clients. Just in more recent time, the business has started to engage in the retail wholesale market upon the hire of 2 new sales guys that have come on board. And that has been really, that traction's gone really strong and the feedback's been really strong from the community. And one of the pieces of feedback that we've received from them is if we could do this in an active ETF form. So that is managing the product and the fund in exactly the same form as it will be, but in an active ETF form. And the feedback there has really been through the ease of access. In terms of the shape of the investment industry and how it's going, we've seen platforms arise which are doing a really good job, but even on the top of platforms, an ETF type of product seems to be really appealing for a lot of investors. So for us, given that we've got a lot of traction for people wanting to invest in the mid-cap fund, we've decided to put it in an ETF structure. You'll be able to trade it on the day, provide liquidity and get access to exactly what we've been managing for over 18 years now.
Okay. So finally looking ahead to 2026 and beyond, what are the biggest drivers for mid-caps for the next 12 to 18 months?
Yeah, again, probably a bit boring, but more of the same. I think, you know, like you said before, we've seen a strong rally, and that's true. And I think it was Peter Lynch said that there's definitely been more money lost for those sitting on the sidelines than those actually participating in the correction. So I think everyone's always waiting for corrections to play out. But if you look at the setup for mid caps and even the broader Aussie equity market going forward, it's quite exciting. So for us, in terms of what do we see, in terms of the makeup of the mid cap 50 and even our portfolio still, all of those names that sit in there have very strong bottom-up stories. So it's not necessarily a macro overview or overlay that's impacting them. They all have their own structural tailwind sitting behind them, whether that's Hub24, that's again just printing consistently really strong net inflows, whether that's REA continuing to take further market share in the listings market, or whether it's ALS continuing to grow double digits in the next couple of years. There's all these stories that sit within that space that we think will continue to compound over the next couple of years. So yes, you can always see short-term volatility in equity markets, and that's just the risk of investing in equity markets. But we think as we look forward, it's really exciting and think that we should see more of the same from what we've seen more recently. So we're really excited about it. We're really excited about the ETF launch and can't wait to get it going.
When's it being launched, by the way?
On the 5th of November will be the first date. So
Exciting.
we're excited to ring the bell and bring it to market. Yes.
Sounds good. Okay, thanks Jordan for sitting down with Livewire today.
Thank you very much. Thanks for having me.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.